Welcome everyone to the DBRS Morningstar Global Commercial Real Estate Outlook. This is the second and final installment of our 2023 biannual outlook. With 2/3 of 2023 over, it's time to discuss DBRS Morningstar's expectations for the remainder of 2023 and 2024. Since our last review on March of 2023, the global real estate markets continue to be in a heightened period of uncertainty. How has this affected our views? Is the medium-term outlook for commercial real estate still as negatively tilted? Has North American commercial mortgage-backed securities experienced further cracks in the office and continued softening in multifamily and industrial sectors? As market values have been declining, what has happened to loan maturities in the North American and EU CMBS markets? I'm Brenda Lum, Managing Director and Head of Global Corporate Real Estate at DBRS Morningstar, and will be the host of today's webinar on Frontline Perspectives on challenges facing the global corporate real estate, North American CMBS, and European CMBS markets. Some of these challenges include elevated interest rates, persistent inflation, and physical occupancy. And within these challenges, what are opportunities that exist? The featured speakers for today's webinar are Chris Tsichlas, Senior Vice President of Corporate Real Estate, Steve Jellinek, Vice President of CRE, and Mirco Iacobucci, Head of European CMBS. I'll ask Chris, Steve, and then Mirco to introduce themselves and provide some context on their coverage universe. With that, I'll turn it over then to Chris to kick off the formal remarks. Following formal remarks, there'll be a session for the speakers to address questions that I hope will be submitted during the presentation. For those not familiar with BrightTalk, there is a button at the bottom of the slides that you can either type in your questions during the presentation or shortly thereafter. And with that, I'll turn it over to Chris.
Thanks, Brenda. Thanks everyone for joining us. For those that didn't join us in March for our original 2023 Outlook, I'm Chris Tsichlas. As Brenda mentioned, I'm lead analyst and Senior Vice President on our corporate real estate team at DBRS Morningstar. I joined DBRS Morningstar in 2017, and I'm based in Toronto. My background is in real estate and corporate finance in a variety of roles, including credit, M&A, and valuation. For some perspective, our team covers REITs, REOCs, and pension plan real estate entities globally. Asset classes covered include retail, office, industrial, multifamily, as well as seniors housing and temperature-controlled warehousing, with portfolios ranging from approximately $100 million in annual EBITDA to over $3 billion. Our current ratings range from BB high to AA. I'll now turn it over to my colleague, Steve Jellinek.
Thanks, Chris. Good morning, everybody. Thanks for joining us. I'm Steve Jellinek. I head up research for DBRS Morningstar North America, and I've been in this position for more than 10 years, and I have more than 30 to 35 years experience in commercial real estate directly. Just big picture wise, in terms of DBRS Morningstar's rated universe, we rate about a little over $450 billion in commercial mortgages. And you can see the different components of that. And that number is down about $7 billion from our last webinar. Things really haven't changed a whole lot in terms of volume rated, although it's not a shock for anybody on the call that the landscape has changed a lot. In terms of the individual sectors, if you will, the only meaningful increase in our rated universe is agency CMBS, which is up about $15 billion from our last meeting. And with that, I'll turn it over to Mirco.
Hi. Thanks, Steve, and good morning, everyone. My name is Mirco Iacobucci, and I head the European CMBS team here at DBRS. I joined DBRS in 2017, and I've been involved in commercial real estate at CMBS since 2007. As you can see from our slide, the universe of European CMBS is much smaller than what we have in US. We rate approximately 8 billion of commercial real estate-backed securities in Europe, and the overall market is just above the 12 billion. Most of the transactions are actually secured by assets in the United Kingdom and subsequently in Italy and Germany. And most of the assets that we rate are actually in the logistics sector. There are at the moment only 3 loans in default and special services here in the portfolio that we have under surveillance. And in general, so far this year, the performance of our portfolio has been pretty stable.
And with that, let's dive into our updated outlook for global corporate real estate. My commentary will serve as an update to our 2023 Outlook webinar that we hosted in March. As we can see from the chart, year-to-date issuance volumes are approaching 2022 volume, and we would expect that by year-end, 2023 issuance volume will be modestly ahead of 2022, generally consistent with our prior expectations, notwithstanding the fact that interest rates remain higher for longer. The increased issuance volume is mainly driven by larger deal size, while the number of deals is smaller. We note that debt maturities for our rated universe are relatively elevated in 2024, which could support an upward trend in issuance volume through next year, as well as the possibility of lower rates further contributing to issuance. On the other hand, issuers continue to demonstrate success in sourcing alternative sources of capital, such as through the outright or partial sale of non-core assets and secured or unsecured loans through banks or other lenders. However, we anticipate these alternative sources of capital have their limits. And based on what we're seeing, real estate entities remain committed to the unsecured bond market and are often willing to pay a premium to fund with unsecured bonds, given efficiency of execution and the flexibility afforded. Now, in terms of our near-term sector outlooks, the operating environment continues to be more constructive than we expected pretty much across the board, with stable to very robust same property net operating income growth, as some sectors such as retail and hotel continue to bounce back from the pandemic to new heights, and other sectors continue to benefit from secular tailwinds such as multifamily and industrial. We've seen idiosyncratic operating performance in seniors housing, depending on market exposures, with some markets positioned to benefit from pent-up demand and bouncing back fairly strongly, while other markets dealing with oversupply continue to lag. Not unsurprisingly, the office sector has been a relative laggard, but nevertheless, operating performance has been fairly stable for our issuers with office asset exposure. Office assets in the portfolios that we rate tend to be the higher quality, well-located, and well-amenitized variety, which has been supportive of cash flow stability during the recent flight to quality. That said, we maintain our negative outlook on office, with risks clearly weighted to the downside. Secular headwinds continue to weigh on the sector, such as oversupply, obsolescence of older, less desirable assets, and work-from-home dynamics, particularly in weaker markets, not to mention the heightened odds of cyclical recession risk. We have, in fact, modestly revised lower our asset quality assessment of several rated office portfolios during the course of the year, while recognizing that long-term leases to high-quality tenants and the aforementioned flight to quality should continue to mitigate downside risks to some extent. We continue to have a negative outlook on seniors housing, operating performance and transaction activity has been constructive, although the recovery is progressing more slowly than we expected. We maintain our stable outlook on industrial. While momentum in the sector is slowing, as evidenced by lower absorption, industrial portfolios that we rate continue to benefit from high and stable occupancy rates, as well as sizable positive spreads between current in-place rents and estimated market rents. To us, this dynamic continues to imply cash flow stability and downside protection in the event of a further economic slowdown. We continue to have a stable outlook on temperature-controlled warehousing. Many leading operators have successfully navigated the highly inflationary environment and are demonstrating strong operating results, and leverage is declining to pre-pandemic levels. While multifamily assets have demonstrated very strong operating performance year to date, we do anticipate some softness next year in certain markets at risk of short-term oversupply. However, longer term, we expect the necessity-based nature and lack of affordable housing to continue to support cash flow stability in the sector, thus supporting our stable outlook. Fundamentals in the retail sector continue to improve, and operating performance of rated portfolios have in fact exceeded our expectations. Just to recap the favorable supply and demand dynamics. On the supply side, there hasn't been much development of new retail assets, while many obsolete assets have been converted into alternate uses. The demand side has been supported by the prevalence of omni-channel retail strategies, a stronger tenant mix with more necessity-based retail exposure, and the addition of non-traditional tenants such as educational institutions. Notwithstanding the strong fundamentals, we remain cautious of recession risk and the health of the consumer as economic momentum slows, which buffers our stable outlook. One thing I'll add here, which I think applies to most of the sectors and is especially most relevant for the highly levered office and seniors housing sectors, is that we have seen and continue to expect further improvement in leverage as measured by total debt to EBITDA metrics. This has been achieved by 1, the aforementioned strong operating results leading to organic declines in debt to EBITDA metrics, and 2, several issuers continue to demonstrate access to alternative sources of equity capital, such as through non-core asset sales that can be used to reduce outstanding indebtedness. Excuse me. Lower leverage can, of course, help offset weakening interest coverage metrics in the current rate environment and soften the impact of a potential recession. Now, moving on to our ratings outlook. When we last hosted an outlook webinar in March, topical risks were high inflation and interest rates and recession. Fast forward 6 months to now, and the rate of inflation is declining and has proven manageable by our real estate issuers. Interest rates remain high and might do so for longer, but incremental increases from here are likely to be less impactful. The wild card is recession, which continues to present significant further downside risk to credit profiles that we need to be mindful of in our outlook. In the meantime, several factors have been supportive of credit risk profiles, including 1, the favorable operating environment and stronger than expected operating results, 2, credit accretive transactions, and finally, 3, development risk is on the decline as many issuers temper growth in the current high cost of capital environment. Barring another shock, credit risk is generally stabilizing. These positive factors cause us to question our modestly negative rating outlook. However, ratings continue to be well placed within their respective categories, and offsetting the positives are higher cost of capital weighing on coverage metrics and significant downside risks, such as the secular headwinds facing office and, of course, recession, which is factored into our outlook. Due to slowing economic momentum, we do not currently expect this stretch of strong operating results to continue past the near term, say through 2024. Thus, we maintain our modestly negative outlook for the time being. So where might real estate entities see opportunities at this stage, and what are the credit implications? It seems there are growing signs of distress in the industry that could broaden the set of investable opportunities for a broader range of capital providers. This could in fact accelerate transaction activity, which remains muted, particularly in the office sector, and create opportunities for both buyers and sellers to achieve their respective goals. To the extent transactions are structured in a credit accretive way, this development would be a clear credit positive. Many REITs and REOCs continue to struggle with the ongoing dislocation in capital markets, or in other words, high cost of capital, which continues to result in heightened shareholder activism, strategic reviews, and restructurings with the aim of closing the gap in public and private valuations. We continue to view significant change in strategic direction and execution risk as a credit negative. Thank you very much for listening to our updated outlook for global corporate real estate. And with that, I'll now turn it over to my colleague, Steve Jellinek, to talk about our outlook for North American CMBS. Thank you.
Thanks, Chris. Hello again. Thanks again for joining. Appreciate it. So since we last met back in March, the commercial mortgage-backed security landscape has softened in some areas and kind of met expectations in others. What I'm going to talk about is a little bit, I'm going to first hit on the big picture, talk about what we see happening kind of nationally, and then I'll dive into each of the property types and kind of give our kind of nuanced perspective on some of the details that we think either might buoy the property types going into next year or might drag them down a little bit further. So with that, let me get into it. So obviously new issue continues to lag. Our new issue for CMBS is down from last year at this time by about a third, about $20 billion in new issue through the mid-September this year compared to around $60 billion last year. Again, it's no shock to anybody that we're seeing rising office distress. And the maturity payoff rate continues to deteriorate. So what are the headwinds? So we have tightening credit conditions. Are we going to see a mild recession? That is pretty much the wild card. And it's interesting that some real estate fundamentals, as I mentioned, within some sectors, such as industrial multifamily, are relatively healthy and positioned to weather a slight downturn, while office will definitely continue to drag the entire sector down, and with it the delinquency rate and the special servicing rate. So as far as new issue goes, as I mentioned, through first week in September, we've seen about $24 billion in CMBS new issue versus about $62 billion last year. Pretty much the same factors are at play as they were 6 months ago. Cost of hedging, higher cost of capital, lower property values. Are we going to see a busier fall after a summer lull? Maybe a Fed pause. I know the markets are heavily betting on a Fed pause in interest rates. And that would be a good sign for the CMBS market. I think the biggest risk is volatility. If the markets can stabilize and if investors and lenders and borrowers see more of a stable interest rate market, then all the players involved, I think, will feel more comfortable and we can feel a little more optimistic about a pickup in new issue. So getting into the rising distress a little bit, still from 30,000 feet, the overall delinquency rate's up to about 4.12%, and that's up from a post-pandemic low of 2.81% back in December. And the overall special servicing rate is up to 7.12%, and that's up from a post-pandemic low of 4.78% set in July of 2022. Most of the rise in both of those stats is driven by surging office distress. And probably the third time I mentioned office in this discussion, and definitely not the last. Some of the factors behind that are hybrid work, driving footprint reductions, as well as falling rents and occupancies. Okay, so with that, let me dive into office and kind of what we see out on the ground and kind of little tidbits that might give a little inkling to where we think it might be going. So the good news is that 2/3 of all U.S. office buildings were more than 90% leased as of the second quarter, according to CBRE. Now, that's not great, but it may not be as dire as you might think. It's down from about 71% leased in the first quarter of 2020, so it's only a 5% reduction. Now, the bad news is that the U.S. vacancy rates for office in the second quarter hit a 30-year high of 18.2%, and that's definitely a concern. CBRE is saying that it might hit a peak of almost 20% by 2024. So in terms of what we're seeing in office is a shift away from downtown to suburban. Most downtown vacancy rates are higher than suburban rates. The top 5 downtown vacancy rate increases are in San Francisco, Seattle, Charlotte, Portland, and Denver, while the top 5 suburban vacancy rate increases are Albuquerque, Tulsa, Albany, New York, Las Vegas, and Riverside, California. In terms of divergence, Seattle actually had the largest divergence between increased suburban and increased urban and decreased suburban. Seattle downtown increased 1,590 basis points, while the suburban increased only 430 basis points, and that's since Q1 of 2020. Okay, now, even as those bad numbers might seem, there's something to keep in mind, that about 10% of all the U.S. office buildings account for 80% of the occupancy losses between 2020 and 2024. And those are mostly seen in big cities like San Francisco, Manhattan, and Los Angeles. Now, the wild card is going to be the September return to office. We've seen more companies like Zoom and Amazon have begun to tighten their policies and requiring workers to come back to the office. Now, looking at absorption, absorption is definitely bifurcated by property age. And buildings built after 2020 saw positive net absorption. And we're going to issue a more detailed report on our office outlook, looking at specifically office maturities in the coming week. And we will focus heavily in that paper on property age. Now, even at the height of the pandemic, absorption has remained in positive territory even as demand has slowed. But the older properties are facing significant downside risks. So there was a building boom in the 1980s. Maybe not everybody that's on the line today remembers that, but suffice to say, I'm old enough to remember that. The properties that contributed the most to vacancy, the current vacancy, actually the vacancy increases, were actually built between 1980 and 2010. Now, a lot of these are classy buildings, but in one perspective, we can view those as those have become the new commodity stock, and they're being replaced by newer, more well-amenitized properties, and that's where we see demand. Kind of counterbalancing, and we're looking at a slow supply pipeline that might be counterbalancing the underperformance. So completions have been dropping since early 2022. The headwind, though, is nearly 3/4 of those deliveries over the next 2 years are in the top 15 markets. And in those markets, a lot of those deliveries represent more than 5% of the existing stock. Those markets include Seattle, San Jose, Austin, Miami, and Nashville. However, markets like Austin with strong employment growth should be okay because of the continued strong demand. Okay, flipping next to hotel. Interesting story here because of a flip-flop in demand since the pandemic. Overall, we're starting to see growth soften. More than 70% of the market showed positive RevPAR growth in the second quarter, and that had fallen to just 45% by July. Now, early in the pandemic, as most remember, resorts and drive-to locations were outperformers, and they led the recovery. In return to normal, resorts continued to weaken. And in another shift, urban hotels, which lagged early in the recovery, accelerated in June and July. And 2 additional location types, suburban and town, began to post negative RevPAR growth, while interstate actually softened further. In terms of pockets of strength, higher-priced hotels, including upscale and luxury, are all posting year-over-year RevPAR growth. So that's a good sign. Key drivers in hotel. So increased consumer purchasing power. It's interesting that in Q2 2023 was the first quarter that wage growth surpassed increases in airfare and RevPAR. And that suggests that consumers have increased ability to travel within the U.S. However, there's always the other side of the coin, and more U.S. travelers are going overseas, and that contributed to weaker than expected demand over the summer. And we also have to factor in short-term rental demand, which actually continues to outpace hotel demand. So what does this all mean for hotels? Well, operating margins have been under pressure since the end of 2022. A couple factors behind this. One is hospitality wages are growing faster than RevPAR, and the other factor is labor shortages and reopening of amenities that are pressuring profit margins and profits. So in terms of our outlook, as far as the special servicing rate, back on the previous tables, the special servicing rate is shown as steady for now. But if you look at the delinquency table, the delinquency, there has been a recent rise in delinquencies for hotels, which suggests that the special servicing rate is poised to rise in the future. Okay, moving on to retail. 2022 was pretty robust, as Chris mentioned, and retail was very resilient, but consumers will have fewer tailwinds going forward. Consumer credit costs are rising and their savings are rapidly depleted, which will eventually begin to take a toll as they'll start to, we also have to factor in the restart of student loan payments. So this slowdown in consumer spending should start to affect retail demand, and this can be seen in the second quarter net absorption that turned negative at power and lifestyle centers and malls. While newly formed post-pandemic suburban consumer shopping habits continue to bolster neighborhoods, community, and strip centers. In terms of post-pandemic shopping habits, it's interesting to note that there's actually been a shift in availability caused by the post-pandemic shopping habits. For the first time in 15 years, suburban availability has actually slipped below urban availability, according to CBRE. With the rise of remote work, workers are now spending more money closer to home. And an additional tailwind is the lack of new supply. There's high development and construction costs, and just 2.7 million square feet of completions in the second quarter of 2023. And that's a far cry from the nearly 50 million square feet that were completed in late 2015, or stretching even farther back to the end of 2007, we saw 40 million square feet in completions. So with few new completions, fundamentals remain strong and prime space remains in high demand. So what markets do we think will continue to shine? Well, in terms of markets, the Sun Belt definitely continues to shine. Orange County, Phoenix, and Tampa continue to dominate in terms of rental growth. And interestingly, San Francisco, unlike its office market, actually snuck into the top 10 growth markets as new retailers are expanding in the city and the surrounding area, which potentially will drive rental growth. The next sector I'd like to touch on is industrial. Industrial is interesting because it's actually facing some headwinds, but we think it's more of a return to normalcy after pandemic-fueled frenzy. In industrial, we're seeing sublease space rise. The amount of sublease space available is actually doubled from the fourth quarter of 2021. Some of these markets include 3 Southern California markets: Riverside, San Diego, and Orange County. And Salt Lake City, Utah was actually number 1. And more interestingly, most of the increases in sublease space were specific to assets that were on the larger side, about 300,000 square feet and larger. We're also seeing slowing pre-leasing and construction. Pre-leasing and construction starts have been on steady decline since the end of 2022, and they declined for the 4th consecutive quarter. What's driving this? Rising debt costs and broader market volatility. And because of this, first-generation distribution space on the market in the next couple of years will be limited. We're also seeing a significant drop in large leases. Leases above 100,000 square feet dropped by about 24% through the first half of 2023. And that dropped to 241 million square feet from 317 million square feet. Interestingly, e-commerce only industrial space saw the largest year-over-year decline in lease volume, an eye-popping 52%. While auto and food-related occupiers saw the largest year-over-year increase in lease volume. Given all that, we definitely see a return, most of the categories returning to equilibrium. We have a sustained increase in availability. After peaking near 14% in late 2022, rent growth should fall back to a more manageable mid-single digits. We expect completions to continue to decline, and we expect demand levels to rebound towards normal. Shifting to multifamily, the big picture is even as national rent growth slows, suburban rent growth is outpacing major cities. America's suburbs are posting the country's fastest rising rents, and a sign that the recent migration of families from major cities is starting to look more long-term. Rents in suburbs declined 26% this past July from March 2020, 8 percentage points higher than the gain in the urban cores, according to a report from Rentals website Apartment List. What's more, suburban rent growth was greater than its urban counterpart in 28 of the 33 metros that were studied. Many white-collar workers with remote jobs moved out of city apartments for roomier accommodations during the early months of the pandemic in 2020. Now we're seeing high mortgage rates and high home prices keeping some of the same families renting for longer periods. Rising crime and homelessness in several big cities has some renters looking to the suburbs as well. The trends propping up rents and fueling concerns about rental affordability in suburban areas leading some governments to actually pass new rent control measures in response. Some of the municipalities actually enacting rent stabilization measures include Prince George's and Montgomery counties in Maryland and Pasadena, California. Now, the question is, why are rents flattening for the first time in decades while demand remains healthy, and the economy continues to produce jobs? A few factors. The huge volume of new supply hitting the market is giving renters a lot more options, leading to more turnover among deal-shopping renters. CBRE reports that 2022 saw the lowest absorption, an actual negative 7,600 units since the great financial crisis in the wake of a record year for 2021. And that signifies the market is normalizing after the dislocation of the pandemic. If you look closer, rents are more than moderating. The year-over-year effective asking rents for new leases inched up by only 0.3% in August and remain on track to potentially turn negative by September. And that contrasts with a year ago when annual rent growth measured 11%. So the outlook is supply volumes remain elevated through 2024, which means significant headwinds on rents until 2025. And we also can't forget how the for sale market continues to prop up multifamily demand. So for sale affordability is a key driver. Spiraling mortgage costs for sale affordability should remain low, and for sale affordability offsets the upward pressure on multifamily vacancies caused by two things: a weakening economy and new supply additions in coming quarters. And what does this mean? The upshot is vacancy levels will not rise considerably above the historic trend. So I'd like to wrap up the section discussing maturities. All the sectors that I talked about will drive our outlook for the upcoming new issuance, and maturities factor right into that new issuance. With year-to-date maturity rate below 50%, that is a huge driver of the new issuance outlook. Around 85% is a more typical maturity payoff rate, and that was what we saw pre-pandemic. So for the rest of 2023, we don't see much improvement from where it currently stands. And last year's maturity payoff rate was about 58%, so down from last year. And that's not a level. That's a level that we haven't seen since the height of the pandemic, when it sunk to about 49% in 2020. And that lackluster performance is just another yardstick of how uncertain the markets are. Higher rates and lenders and investors shying away from less stellar shopping malls to office buildings. So that wraps up my discussion of the CMBS market in North America, and I'll turn it over to Mirco.
Hi, thanks, Steve, and again, good morning to everyone. So let's start having a look at the overall European commercial real estate market, and a few numbers that, they they can give us a general picture of the market. So overall, the overall picture is still quite negative. Investment in European commercial real estate in the last quarter were at 35 billion, which is still significantly below where they were 1 year ago, and also lower than where they were in Q1 2023. Also, yields are still widening, and this is generally happening for all asset classes and also for most of the European countries. However, we are starting to see a slowdown in this shift, and especially in the logistics and residential sector. And this is on the back of the strong liquidity for these two asset types, which are seen as the most resilient in these difficult market conditions. Banks lending is also still quite tight. Banks still quite reluctant to lend on commercial real estate. Overall, there's been a 42% drop in new commercial real estate loans in Europe, and expectations are for a further decrease in the second part of the year. However, on a more positive note, I would like to highlight that finally inflationary pressure in Europe is starting to ease in most of the European countries. Expectations are for central banks to probably increase rates once or twice, but already you can see that in some European countries actually inflation is getting in line with what are the targets of the ECB. And on the back of this, we would expect that this will bring a stabilization of the financial market. So less volatility would also mean that we will likely see basically a re-entry of capital in the European commercial real estate sector. If we move to the asset type that we have in our portfolio, we basically have to confirm what were our outlook at the beginning of the year. So we confirm our negative outlook for the office and retail sector, despite the fact that in both these asset types there are some peculiarities that is worth to highlight. So in the office sector continues this separation between prime office asset, which can benefit from green certificate, and they can benefit from ESG credentials. So for this asset, actually, the story is still pretty positive. Occupancy levels are still really high, and they can still demand quite significant rental growth. However, the picture is completely opposite for secondary office space, which are still suffering, and there's lack at the moment of liquidity, and the struggle to get not only new tenants but also be able to refinance in the capital markets. Retail is also still under pressure, but here I would like to highlight a couple of points. One is that we are finally starting to see some new transaction. The market was literally dead for months in Europe, and we were struggling even to see some transaction, in particular in some Southern European market. Now some investors are coming back into the sector, and you actually have visibility on some transaction out there in the market. The other, I would say, positive note is that, as we know, banks, but also CMBS investors have been really reluctant to basically invest in retail asset. We are now, however, seeing some non-bank lending participants that are actually looking at this asset class again, and they're also keen to basically finance at LTV levels where banks will not do absolutely. Instead, if we move to what for the asset type where instead we have a more positive view, Starting from the logistics, as I mentioned at the beginning, actually the large majority of our portfolio is secured by logistic assets, and overall the picture, as I previously said, is still quite positive. Performance are stable. We keep seeing, rental growth in most of the portfolio, and in general, also banks and lenders are still quite keen to finance this asset class. And for the residential sector, and where we say residential sector, we also wanted to include not only the private rented sector, but also the student accommodation. Is actually at the moment the picture is quite positive. This asset type is seen by investors as relatively strong and secure by the current macroeconomic uncertainty, and as a result, in the last period, investment in this asset class has actually been higher than in the European office market. And finally, we would like to mention the hospitality sector. In 2022, we actually witnessed a really strong recovery of this asset type. The performance also in 2023 remained quite strong, mostly driven by higher ADR compared to pre-COVID levels. Occupancy is also growing, but we have not really achieved again occupancy level that we had pre-COVID. However, we would also like highlight here the rising costs for the sector, which actually are starting to eat margins and profit for the hospitality sector. If we then move more specifically to the European CMBS market, we actually start with the good news, because recently there was actually the first deal in the European CMBS market, last mile logistic, with Blackstone as a sponsor, which has officially reopened the European CMBS market in Europe, a market that has been basically closed since May 2022. The deal overall was fully placed. However, we would like to highlight that probably the pricing achieved by the transaction was still likely to be 50 bips higher than what the same transaction would have been able to achieve in the banking syndication market. Also because, as I previously said, this is an asset type where banks are still really keen to lend. However, as I said, this deal reopened the market, and we would actually expect a few more issuance before the end of the year. So we will probably, at the end, terminate the year in line with our expectations, which were for 6 or 7 transactions. We believe that there's going to still be potential for issuance for transactions secured by the logistics, but also for multifamily deals. A potential also some office transaction, where a little bit the secondary position of the asset, a little bit the story behind the asset with some potential restructuring to be done of the asset, might have scared bank lending, and as a result, they might end in the European CMBS market instead. Also, what we have seen in our portfolio during 2023, but also starting 2022, is that more and more often sponsor try to extend their loan maturities, and in some cases even eating in the tail period of the transaction. Now, in some cases, this can be a case of extend the pretend, but in other cases we actually think that it might be the right option, because the assets are still performing, and the fundamentals are still good, and they just need to wait for a recovery of the liquidity in the market. 2023, in terms of maturity profile, will actually be relatively quiet. We only have one transaction that is due to expire in the next few months. It's a logistic deal, and we actually still think that they should be able to refinance in the market. However, 2024 is expected to be a really different story. We actually have around 2.6 billion of CMBS maturing. And again, for some of them, we will see at the moment significant issues in refinance the transaction. As a result, we would expect more situation where the sponsor will approach the servicer and will try to extend the loan and expecting a recovery of liquidity in the market. And with this, I hand over to Brenda for the QA section.
Yeah, thank you, Mirco. Really appreciate that. We have, maybe just as a reminder, that there's a button at the bottom of the slide so that you can actually submit your questions, and that'll pop up for us. We do already have a number of questions, so I'm going to try to group them, given the interest of time. So the first one has to do with loan maturities. Mirco, you just talked about what's coming up in the 23 and then a significant more in 24. Can maybe Chris, I'll start with Chris and then Steve, just talk about the maturity volume over the next 12 to 18 months. As well, in terms of loan maturities, how do we factor in that into the analysis on a CMBS side as well as a global corporate real estate side? How about if I ask you, Chris, to start first?
Sure. Thanks, Brenda. Good question. So, as we mentioned, we're expecting elevated maturities in 2024 and again in 2025. And so maybe with that kind of sort of context, we'll just back up and note that our methodology with all the various business risk assessment and financial risk assessment factors functions like a matrix. Weakness in one factor can be offset with strength in another. There aren't any bright lines, so to speak. And when we think about triggers to positive or negative rating actions, we often focus on the financial risk assessment factors because they're more likely to shift meaningfully in the near to medium term. So with recent deterioration in interest coverage metrics, which is something that we expect in our outlooks to persist with rates remaining higher for longer, issuers have less tolerance for leverage at a given rating level. And so leverage thresholds for negative rating actions are being tightened. In other words, sustained higher rates are contributing to weaker credit risk profiles, holding all else equal. However, we do recognize offsetting factors such as declining leverage, less development risk, and the like that are helping to mitigate the impact of higher rates on coverage metrics and credit profiles. Steve, did you want to add something?
Yeah, sure. From the CMBS standpoint, we're tracking a little over $40 billion in conduit loans maturing through the year in 2024. Retail represents the largest portion of that at about $15 billion, and office is about $11.5 billion. And back to my discussion on office, that we see the office refinance rate or maturity payoff rate could go as low as 25%. That is for a successful payoff rate. Retail is performing pretty well with the exception of anything but stellar malls. Hotel could see a decline in its payoff rate as the market softens. But generally how we're handling these things from a rating standpoint is we're stressing loans with upcoming maturity dates. We often cap in-place cash flows with our more conservative cap rate ranges. and that results in LTVs pushing our expected losses for those loans well beyond pool averages. Mirco, anything to add?
Perhaps I think we may have just dropped Mirco for a second.
Sorry. I mean, as I said, on the maturity profile, we have quite a few loans maturing in 2024. To be honest, we again, large majority going to be logistics, and as a result, we are quite positive on their chance to find refinancing out there in the market. However, there are also a couple of office deals, which instead at the moment are, I think that they're going to struggle because mostly because interest rates have gone up, and as a result, yields have gone up, and so this asset, even if overall are still performing, just a drop in value will make it difficult to refinance without significant equity injection from the sponsor. So there are going to be a few challenges out there for quite a few of the loans that will mature next year.
Excellent. Thank you, Mirco. Which kind of leads to our next question with regards to cap rates. With rising cap rates, what's the implication? And I think, Mirco, you mentioned about valuations for refinancings in some of your transactions. Is that the same across the board on the North American CMBS side? If I could turn that over to Steve.
In terms of rising cap rates?
Yeah.
I'm sorry, can you repeat the question?
Sure. With rising cap rates, what's the implication on some of the loan refinancings that have to be done in this upcoming 12 to 18 months?
Yeah, for sure. I mean, rising cap rates is, it factors right into the refinance equation with rising cap rates. The amount of available funding for refinance is going to go down. And the only one positive to take away from all the discussion about refinance is that a lot of the loans that are coming due now were conservatively underwritten, at least compared to the Great Financial Crisis. That's not going to help them, a lot in terms of rising interest rates and rising cap rates, which is going to limit the takeout financing. So rising cap rates and rising interest rates in general are a definite headwind in our view when it comes to limiting the amount of volume of loans that are going to successfully pay off at maturity. And we're seeing this play out most heavily in come back to it again, but the office sector. Not only are interest rates and cap rates at play here, but we're also, lease rollover and decreasing office usage and rising availability rates are driving that low office maturity payoff rate.
Right. Thank you, Steve. We are almost out of time, but we can, if we do one more question, I thought this was a really interesting one that really focused in on your statement, Steve, on older buildings. The question is, are older stock buildings in good locations managing okay? And are they also seeing higher vacancies? And if not, if they are not seeing higher vacancies, why? I think I'll put that to Steve, and then anyone else wants to jump in.
Yeah, that's an awesome question. So we conducted a really large study on office and looked at it through a lens of property year built. And basically, one of the things that we noticed was that the 5 largest MSAs with greater than 20% decline in appraised value. These are specialty service loans that have been reappraised. They've already defaulted. The 5 largest MSAs showing a large decline in appraised value are Chicago, Denver, Houston, surprisingly New York, and Pittsburgh. Case in point, in Chicago, 175 West Jackson, it was a $250 million loan, or is a $250 million loan. And the property's appraised value fell down to $410 million. It fell to $195 million, down from $410 million of issuance. It saw its occupancy drop to 62% in December 2022, and the loan faces a November 2023 maturity. Give you one more example. In Denver, which is downtown Denver, has high concentration of oil and gas exploration companies in their office buildings. Republic Plaza, again, over a $250 million loan, 56-story, 1.3 million square foot property, had a maturity date in December 2022. It didn't pay off. March occupancy was 78%, and it recently fell to 67% after one of its midstream exploration company's tenants vacated. And the property was built in 1982, older property, and it was appraised for just about $300 million back in December, which was 44% lower than its at issuance appraisal of over $535 million. So yes, to answer the question, we are seeing distress among older properties in decent markets.
Excellent. Thank you, Steve. Anything to add, Chris or Mirco?
Yeah, I mean, sure. Thanks. Maybe I can just jump in quickly. If we think about older buildings and good locations, and we define good locations as, well located near transit hubs and, amenities, and the buildings are well managed, I would say, and say they're in Toronto or Manhattan, cities that continue to grow and aren't really dealing with perhaps the risk to safety that some other cities are dealing with. I think those older assets, I think we're seeing them perform fairly stable. Maybe occupancy is declining a little, or there's a little volatility around occupancy, but rents might be growing to sort of offset that. But on the other hand, issuers are having to invest. Leasing costs or tenant incentives are increasing. So they're having to high grade the space to get it leased. And I guess that goes back to sort of the well-managed aspect.
Excellent. Thank you, Chris. Maybe we're really short on time, but if you have sent in a question and we're unable to answer it just due to lack of time, we will get a response back to you via email. So appreciate that. On behalf of Chris, Steve, Mirco, myself, thank you for your time and participation in today's webinar. We'll also be sending over a copy of the presentation slides to all of you that are attending. And we hope to see you in the next DBRS Morningstar Global Commercial Real Estate Outlook discussion in early 2024. Again, thank you on behalf of the group. Have a great day.
Thanks, everyone.
Thanks.